Hello everyone, welcome to another episode of Market Makers. Today we have with us the management of Cigniti Technologies Limited. We have Mr. Krishnan Venkatachary, CFO, and Mr. Sairam Vedam, Chief Marketing Officer. Welcome, sirs.
Yeah, good morning, and thanks, Milind, for having us.
Good morning, and thanks for giving this opportunity.
Thank you so much. So, I was going through your corporate presentation and it mentions that Cigniti is world's leading AI and IP-based digital assurance and digital engineering company. Now, could you throw some light and help us understand what is the company's business and what do these terms, digital assurance, digital engineering mean?
Yeah, so I will try to keep this as simple and explain this whole thing. So Cigniti Technologies, we are known for doing extremely strong approach to software testing quality assurance. What I mean by that is the world today, every organization is a software company, as McKinsey profoundly says that, which means that global enterprises across the verticals today use software as a strategic enabler for their market transformations and leadership. But as we all know, quality software is the determinantal factor for companies to be successful. So Cigniti Technologies ensures that global companies get to market faster and better through strategic software testing, quality engineering, and digital assurance services, which means that with automation as the unique focus, we help about 80 of global 2000 companies, more than 200 large companies across the world, and 700 enterprises world over have significantly taken advantage of our undisputed understanding of the domain of how software quality needs to be delivered. So that's number one. And in today's world, that has transformed into a term called digital assurance, because end customer experiences have to be truly frictionless. And digital technologies promulgate customer experience to be the key driver for growth and business transformation, which means that the time that global companies have to release software in a much better way that end customers would love is very, very minimal. And that's where they require a specialized approach to automating the entire fulcrum of software testing, which later became quality engineering, where a lot of code has to be written to accelerate software testing. And then in the connected world, it has morphed into digital assurance. So that's been our singular forte through which we believe that digital assurance hence is the bedrock of modern day digital transformation. The second piece is obviously as companies get transformed through AI, through a confluence of modern day digital technologies with cloud as the unilever mechanism for delivering software, there is a lot of focus on a confluence of digital engineering, whether it is to write applications which are cloud native, whether it is to develop software which are productized and platformized, and then without compromising quality. And that's where digital assurance and digital engineering, through a lot of AI, hyper-personalization, analytics, and data, confluence to become a singular market. And that is where Cigniti plays a pivotal role, as I said, as a very specialist company. Simply put, we bring to market a quality-first approach to digital engineering. And lastly, we have also invested in building platforms. While we are a 100% services organization, we differentiate the acceleration of the delivery through IP and platforms that have a lot of AI intelligence built into it, both for quality engineering and digital assurance. We have a platform called Blue Swan, and for digital engineering through computer vision and active learning and a use of AI technologies, we have a platform called Zastra. So that is what we mean by AI and IP-led digital assurance and digital engineering.
Got it. So, throw some light on the company's history. When did it start, and how the company moved from a pure play testing player to now an AI-based, digital transformation enabler?
Yeah, I think the company was incorporated in 1998. 98 to 2009, invariably, Mr. Subramaniam was a promoter of the company, and from the first generation entrepreneurship, just wanted a passion. He had a passion for software, and then he moved in and started a company, and then started doing everything on the services side, including healthcare and medical transcriptions and various things. But however, in the also company listed in 2004 in BSE and then on to NSE at 2008. 2009, his son graduated, Shrikant Chaklam graduated from University of Southern California. And then he came up with the idea very clearly with all his experience in the post-graduation and the training what he had. He said that let's convert this company into a quality assurance company. I think that is where they started the roadmap in terms of trying to put together various things. And the three P's in focus there very clearly is that people, process, and in places. So invariably, we need to be in the market to survive with the kind of established players. So the company chose a niche path in terms of the QA being the transformative area to penetrate. And with that in mind, basically, it put the team in place, and then the processes today where we are in terms of the best of the processes, which we'll explain as we move forward, whether it is CMMI or whatever it is. And then comes the question of places is that is where the need basically for a $2 million company to acquire through stock swap to go ahead and acquire the name Cigniti Technologies Inc. Mainly, basically, though the company was in the staffing solution, but I think it had enough of customers which we can penetrate through. And today, few of the top 50 customers are from those clients where we have penetrated and they become a top client for us. So that was it, the history till 2012 and 2014, again, 13-14, there was an acquisition called Gallup Solutions. While the first acquisition was at about close to a revenue of 19.2 million, the second acquisition was at about close to 9 million. But I think this gave a jumpstart platform to the company to be over there at about 30 plus million and 35 million by the time we were in 2014-15. And I think if you look at the team coined, probably, if I use the word that we moved from quality assurance to quality engineering as a platform. And in 2017 to 22, the focus was on completely on quality engineering in terms of penetrating. The Corona gave us a food for thought in terms of where we are servicing. I think that is where the transformation and the investments went into Center of Excellence and trying to create the opportunity for working on fewer verticals like medtech devices and penetration into BFSI, and then getting ourselves ready for the digital engineering side. I think so 2021-22, the base was laid clearly for moving into the digital engineering side. These digital engineering and digital assurance, I'll ask my colleague Sai to talk about it.
Yeah. So as Krishnan rightly said, I think he covered pretty much just few things. So as the industry moved from a conventional waterfall model, which used to be the fundamental way of software getting developed 15-20 years ago, we were an independent quality assurance company. Then the promulgation of a methodology called Agile and DevOps, where the entire software dev cycle got shrinked to almost 2 weeks, where you can actually release a piece of software, brought in the notion of quality engineering, where a lot of engineering as a craft and the ability to actually test and automate software right from the day one of the software dev cycle, which put more impetus on quality software, opened up a significant large opportunity for us. So that's what our evolution as a quality engineering company. Then we went on to become a continuous testing company. So continuous testing is called the age of customer, where testing just doesn't stop and it is infinitely infinite model, and testing just doesn't stop actually. But then there is a lot of work that happens after the release of the software in the age of continuous testing. And subsequently, the world of digital assurance got birth, where, as I said, confluence of numerous digital technologies and the heterogeneity of IT environments with frictionless end customer digital experiences promulgated what we call a connected enterprise. So that's where digital assurance was born. And lastly, from there, the world of digital assurance and areas of adjacencies called variety of ops that we do: DevOps, Dev Test Ops, SecOps. These are like where you integrate the ability to write the code as well as release the software and test it all in a single notion, which also gave birth to newer roles of people in software testing, which became more and more important. And finally led to the frontier of digital engineering, where there are three significant pieces: work that you do around data and AI, work that you do for software products platform engineering, and then work that you do around the areas of IoT and ER&D. So that's essentially the evolution path. And I just would like to also emphasize that in every dimension of this, Cigniti is an acknowledged global leader. So we are 6 times recognized in the Gartner's Magic Quadrant. We were recognized by Nelson Hall for 7 consecutive years as global leaders in software testing, quality engineering, digital assurance, and continuous testing, also by Forrester. And today, I'm proud to also, sort of update that ISG proudly put us as a challengers in the world of digital engineering, while we are also positioned as a niche player that is creating a quality first approach to digital engineering. So that summarizes the entire journey of milestones of Cigniti's growth path, as Krishnan rightly alluded.
Got it, got it. So if I, put in very, very simple words, does your company help your clients to roll out their softwares and products faster?
Absolutely. Without a question about it. It's about faster, smarter, better, as much as we could with automation.
Excellent. And how does now AI coming into picture, what do you think could happen to the efficiency or the speed of you helping your clients?
There is a tremendous amount of acceleration. That is why we call ourselves an AI-led company. So there are two pieces in the AI world. There is AI-led, and then there is AI-infused. So a lot of applications that we either test or develop are actually AI-infused, which means a lot of algorithms, a lot of data go into development and testing of those applications. But the way you approach to test or develop them is AI-led. That's where our tools, like the Blue Swan platform, which is a world-renowned platform, a patented platform. Recently, we won Stevie's Award for one of the AI-led low-code approach to test automation that we brought in, and numerous amounts of subcomponents of Blue Swan are heavily AI built. A predictive sentiment analyzer solution that we have an approach where we could actually predict the quality of the software itself based on various parameters, a dynamic dashboard that can actually show the state of quality with 80 different connectors to different parts of an enterprise quality system. So this is all AI-led. Then we also have a platform called Zastra, which is recently was acknowledged by Forrester. It's an active learning computer vision platform. There is a lot of AI that goes into it for solving very interesting use cases of Industry 4.0 in connected manufacturing and medtech. Simply put, it's like sitting inside a car and straight away starting from gear 3 or gear 4. That's where AI-led acceleration comes in. And then we back that up by world-class labs that we set up for our customers, and of course for our own R&D, where there is a lot of work that is happening. Lastly, the productivity gains that is coming through generative AI, is again being passed on to the customers, but it is too very early to determine what sort of productivity gains, because we are all in early stages of adoptions. And then it also brings in a question of enterprise guardrails. We are working with our customers who are hypersensitive than ever before, because the advent of generative AI has its own challenges, but it is for the good, and we are at the forefront of such innovation.
Superb, superb. So, understanding the business in terms of its operations, what is the typical, a customer sales cycle, and, what is a longevity of a customer with you?
Yeah, see, the normal customer cycle, what we have experienced out basically, and we have also graduated out from a $500,000 deal to about what you call a multi-year deal, and then also a deal size at about predominantly most of the deal size coming around 3 to 5 million, and a few edging top notch at about 10 to 15 million or so. About what we've experienced the sales cycles, depending on the criticality and things like that, is that it ranges anywhere between 3 months to 6 months as a sales cycle. But predominantly on all our smaller size deals, basically, we try to close that by about 90 days or so. But it gets fixed in between the 3 to 6 month cycle invariably, even for larger deals, when it is floated through a definitive timelines of RFEs and all. Basically, that is what the timeline which we have seen. But if you look at in terms of the duration of the contracts, the duration, for example, it is up to the company to decide as to what I'll just take a step back. Basically, 2012 to 17 has been a year we said that we need to add logos because we need to make noise and we need to be present in the market. 2017 to 21, 22, we said very clearly that we're going to sustain, we're going to consolidate, and this is what we need to do to really focus and survive. But I think it's very important that we grow within the clients, reduced from 400 clients to, we brought it down to about 250 clients, 230 clients, so that we expand within the clients. 2022 onwards, with digital engineering coming through, we are trying to look at nurturing and strategic growth within the accounts very clearly. So we are trying to look at a minimum. If you look at our longevity of the client, is that if I accept 6 months as a minimum timeline at which I accept for a client, today as a threshold, basically with $500,000. And any client, normally for me, basically is that I have a bracket where on an annual basis renewal on the SOW comes. But I think the maximum projects which I have, except for a top 5 clients where I can count, which is 3-year contract and a 5-year contract, predominantly the nature of the contract is 18 months. So 6 months to 18 months is the cycle which we have.
Okay. So taking a cue from this, from which geographies do most of your revenues come from, and who are your top clients?
Predominantly North American region. North American region contributes and Canada put together contribute about close to say 87-88% of the total revenue. And if you look at, we generally don't name the client because I think the CMO's office does a lot of legal clearances before even publishing the thing. But I think with all the approvals in place, what has been published in the websites, which will also be shared with you, is that I think we have clients, which is one of the major airline industry, which is the private airline industry in the North American region, which is one of the top clients. And if you look at in the top 5, basically, we have a biggest retail chain coming through. And also we have one of the, on the banking side, we have one from the Chicago in terms of a huge bank, which is coming through. So these are clients. And if you just give a glimpse, basically, I think if you look at the top 20 clients contribute about close to 50% of my revenue, clearly.
Okay.
Yeah, and just to add to Krishnan, Krishnan can correct me if I'm wrong. There are 22% on an average between retail and financial services each. We also have medtech as an emerging vertical, somewhere around 14%. And travel, the resurgence of the airline industry, as Krishnan rightly said, also contributes somewhere between 13 to 14%. And lastly, energy, which is one of the fastest growing sub-verticals along with medtech, also contributes about 5 to 6% of us. We can give you the exact details, but these from a vertical split, just to add to what Krishnan sir said.
Okay, so broadly, you have a fairly diversified industry customer base, industry wide.
Yeah. No, we have learned it. We have been heavily skewed when we were there during the corona time. Predominantly, we traveled about 32%. But I think we have researched back by reviewing it, basically, is maintaining the relationship, while we understood that focusing on a single retail could hit the business very clearly. So we have invested our energies and we have come back, and all these investments are paying back very clearly. So we have diversified, and especially what we have seen a push in the, while everybody is talking about BFSI as a vertical which is struggling out or whatever it is, but I think we are focused on the core area, as I said, in terms of the AI and digital engineering and ML, which means that we are able to look at the core applications, and most of them, so for example, if you have to split it out, basically that people are shifting to core banking to the next level in terms of internet banking or whatever it is. But I think we are out hitting the applications at a right stage invariably. So we have not seeing a pressure in the BFSI as a segment, basically, because we are selective in approaching the clients and trying to wed with them for a longer term very clearly.
Mm-hmm. Okay. And we were analyzing Cigniti's revenue growth quarter wise, and we saw that after there was a spike in growth from Q1 FY22. So what changed around that time, and what has been helping you to post decent, or rather higher single digit or double digit growth rates?
Yeah. So if you look at, let's take the 4 years, 1920, 2021, 21, 22, and 22, 23. So if you look at 1920 as a financial year, basically, I think towards March is where we are hit by Corona. What we did about close to, that was a year closing into 122 million, where we started our investments also in expanding in terms of the offerings and capabilities. While the Corona hit, we had our order book position coming down and substantially. And we said that the next year is going to be a tough year in terms of degrowth, but we were able to put our hands and say that, hey, I'm surviving, and we were able to be net neutral, and we were the only company broadly say that we didn't lay off any employees, and we maintained, in fact, for a few customers like the British Airways Group and all, we went ahead and told that please don't downscale us. We will provide you investments in terms of our people sitting and doing the R&D work for you clearly, so that when the industry bounces back, you can always look at us in terms of the long-term commitment to start looking what can be done. So we made investments in those areas in terms of having our people doing the work as to what is needed out. So 2000 2021 to 22, I think it's a fantastic year in terms of 21 to 22. It gave a lot of experiences. We were not deterred by the Corona. We said that 99% of our delivery through work from home was extremely great, and the customers acknowledged. We were able to do that for a fleet of 3,000 plus people, and we still maintained and sustained the revenue, and the profitability went up if you look at it, because there was optimization of cost. Invariably, no client meetings, no travels, no admin cost, with all that, in the sense what reduction in all these costs invariably. And there's a 5% salary cut, which also normalized if you look at it. So that is the reason we were able to get notch higher on the EBITDA. I'm sure you'll be asking a question out on the profitability also. Yeah. That's the reason I'm covering it up basically. While my scale started moving up after 2017-18, while I was doing about 15.5% and went to that close to that 16% in 2021-22. For that reason, invariably is that I have been optimizing on the cost also on that front, if you look at it. And 21-22 and 22-23 paved the way very clearly in terms of the growth. From 123, we went to 168 million, 168, we have gone to 206 million. The growth predominantly is back. If you look at it, the investments which we started investing into the sector started yielding. For example, MedTech as a core on the healthcare started yielding its highest gross margin. It gives me a gross margin at about 43% and contributes about 14-15% of the revenue, where we have started focusing our heads on that in terms of trying to get more contributions from there. So these are the investments which have started yielding into these years. And if you look at the subsequent year on a base on 168 million, I think we were able to, with these investments, we were able to do it. But I think you'll have to normalize the EBITDA. If you look at it from 2021, 22, 23, if you look at it, 21-22 had a share of one-time expenditure in terms of some amount of legal expenditure and some amount of a write-off and with respect to other income which has been recognized in the previous year due to government policies has to be written off. If I normalize that, basically, still I would have been there at about 13.5% on a growth. Tapering a 1.5% EBITDA and trying to grow at about 30% is a fantastic combination, which gives us an assurance internally and also to the customers in terms of how do we, and also to the investors in terms of, yes, there is a growth and we will always be able to optimize and get. And then that was also a year coupled with retention, because the labor turnover was as high as 36%, and we were able to, we need to give 2 times salary revisions we were able to do. We need to do compulsorily to retain the talent. And the H1 was an issue, and we had to acquire people on the contractors. So basically, a resource double whammy in terms of resource coming through, in terms of our investments already making, one-time expenses coming through, which brought us to an EBITDA at about close to 10%, and then brought us on the NEEL on the 7.5% on the PAT. But I think if you look at the subsequent year, 2023, the growth has been a continuing effect of what has been the investments made. And the second portion is that all these one-time expenses not being there, and then we are able to do the improvements, revisions in terms of the customer revision for rates, and realization started moving up. And with the push from Apparat Digital acquisition coming through, which though my colleague will explain in terms of it is a capability-led acquisition, which only contributed about 2.8 million or so revenue in terms of the overall year, and for 3 quarters, which we accumulated in the last year, is about close to 2 million. But I think that's a digital push which it gave invariably will start yielding results, and that is what we have seen from Q1 of this year, Q4 of last year, and Q1 of this year, where the digital push has started moving in. So this is the whole summary in terms of the growth. The growth impetus is on a couple of counts. One, Cigniti's investments completely into the quality engineering space, especially more so with building center of excellence and trying to penetrate the market, and then the newer segments, be it healthcare or other sectors, and then comes the digital engineering investment. So this is giving an impetus to the growth, and we also see a streamlining on the EBITDA, which is running through systematically. Having said that, I'm giving a caution out for the current year, because we are not exception in the industry. We are all part of the industry, and we depend on the same pie of share which is coming through from the market. And we have, and that is what we have categorically stated, that the current year will not be the same as the last year, because there are some instabilities, and we feel that the worst is over in terms of the headwinds. But we are cautious for the 2 quarters, and the effect of it will be felt in the third quarter in terms of what decisions the CIOs make. And we expect overall for the IT industry, the bounce, the revenue positivity to push through or in a big growth way is that effective January or so. So ideally, next year is going to be a very, promising year to look through. But I think this year, though we are not in the process of giving guidance, we will be positive, definitely. But I think we are trying to be cautiously optimistic in terms of what we are trying to do. Yeah.
Got it. Fair point. Understanding the revenue side in slightly more detail, what is your current order book and its execution period?
I can put it out very clearly that we just published the first quarter number with about 53.5 million revenue, with about 14.1% EBITDA. I have also gone on live to tell very clearly that my order book for the period executable July to March is about close to 160 million or so in terms of the order book clearly, which was available when I spoke on July 30th or so, the executable order book from July to thing. And there are a lot of contracts on pipeline, which is there. And this I have considered about 85% renewal only. I have given a cushioning for 15% of renewal not being done on the total renewals, which is coming through during the year and executable and billable clearly, and which can give a slight bump up in terms of that 5%, 10% because we are confident of getting all these things renewed. But still, you need to eventually give scope, and that is what we have priced in at about 160 million in terms of orders. And there are orders in the pipeline, which is also over the last week or so, where we have seen a lot of conversions and announcements coming through, which is a very positive news, including major banks and a few other notable customers, and especially on the digital side, clearly multi-year deal on the digital side, which is really, really encouraging to look through. And then we don't see any customers coming back and pushing back on receivables. We don't see any customers coming back and asking for a rate reduction, and we don't see any customers coming back and telling that, okay, stop these resources, let us stop the project, defer the project. I think all these are gone away with very clearly. So that is a clear positive news, what we see basically. So if you look at the other question in terms of the eternal order book, if you look at it for us basically is that I think we have about over the next, from April next year till about, say, we have about 16 months. Comparing all that, we have an order book already, eternal order book, because as you know that this industry is every 12 months is renewable. We have about close to 60 million of that eternal order book, which is available for those period basically, which is anywhere between 6 months to 18 months, effective April 24 or so. That is in summary. Yeah.
Got it. So, you had mentioned a few minutes back that you have reduced your customer base probably from 400 to somewhere around 200. So, what is the company's strategy to increase the wallet share of, from the customer?
Yeah, so I think the question itself has the answer basically. If you look at it basically, while I have brought down my number of customers from 440 or so to 230 to 40, while I'm not averse to getting into a newer customer, but that should be a logo which can be a sustainable long-term logo. But if you see the growth of the company over the last 2 years has been at about average 30, 35%, 38% or so. If you look at it, 38% on 1 year, 32%, 33% in the second year. So the average growth has been at about 30%. So which means that the strategy very clearly what we have adopted about 1.5 to 2 years back in terms of trying to penetrate and having the accounts classified as a growth account, strategic account, nurturing accounts has worked. And then that is one of the reasons that we have seen that the wallet share within the customers, existing customers, and especially the top 20 customers and top 50 customers where we are focusing has expanded heavily. And that has been the focus very clearly, where we will be a reliable partner for them, which will be difficult for them to dispense with easily. That is the approach which we take.
Yeah, just to add a line to what Krishnan said, it is about upselling to a lot of these customers where we have a significant focus on digital assurance. Now we are able to go and upsell digital engineering, which also means that we are able to serve more than one tower inside those organizations. We have traditionally been working with DevOps, quality engineering, CIOs organizations. Now we are also able to work with a chief technology officer, chief analytics officer, chief data officer sort of towers. So that helps us horizontally penetrate and expand into these growth strategic nurture accounts. So that is leading to this sustained growth that Krishnan was speaking about.
Makes sense. Okay, so now let me pivot to understanding the industry trends. So my next question is, what is the market size of the services that Cigniti provides, and what do you see as a a CAGR over the next few years?
I'll take the first part of it. So fundamentally, the entire digital assurance market, first of all, as Nelson Hall, one of the prominent analyst firms which actually tracks this entire testing industry more prevalently than anyone else, pegs the quality engineering, quality assurance, digital assurance industry to $43.5 billion. So that's one market segment. Then there is another market study which also tells by a reputed analyst firm that it is actually $60 billion when you include a little more adjacent areas of digital assurance. So that's number one. Most importantly, the subset of that, post the recessionary headwinds also, for the next 5 years CAGR, this testing industry, the digital assurance part is actually expected to grow between 10 to 12%, which is like double-digit rates if you still see. That is a $17 billion, the subsegment, which is called the new non-functional emerging. There are many ways to coin it, digital assurance, which is a subset of the overall quality. So it's a $60 billion industry under which the digital assurance subsegment is also growing at 10 to 12%. So that's the number one piece that we are looking at. The digital engineering piece anyway ranges between $350 billion to $700 billion, which is a massive industry. The digital assurance actually folds up into that. And the latest IDC's research says that the cloud native software product engineering services alone is expected to grow up to 15.5% CAGR. So net, we have twin focus, digital assurance, which is growing at 10 to 12%, digital engineering, the software led, which is growing about 15.5%, and an overall market, which is about $700 billion. And lastly, as Gartner said that the IT services industry itself is expected to grow by 8.8%. This is a very revised estimate. And in 2023 and in 2024, it is expected to cross 10.2%. So that's the overall landscape. We can double click into any of this. In terms of our CAGR growth rates, I will let Krishnan speak about that.
Yeah. So if you look at basically, Milind, is that we generally don't give any guidance, but I think the internal targets, what we have set out very clearly is that it's something more than high teen growth is living 1 year as an exception, which is the current year if you look through. But I think from 2022 to 28, we have set ourselves an internal target to be there at about close to 625 million with an average size on a base at about close to 130 million, 140 million, 123 million, where we started. We wanted to be there at about average at about 25%. It turns out to be a CAGR very clearly, which is an achievable and no mean task. Yes, probably that could push up by a couple of quarters because of the last quarter and then the couple of quarters what we expect, the kind of headwinds which we have seen and then the effect of it in the economy probably will come down. The second thing is that we also have plans on certain inorganic measures, which is basically is a opportunity as and when it materializes. But I think we are very serious about it. Coupled with these two, we want to be $1 billion company in terms of the turnover by 2028. While we have set ourselves an ambitious target, but I think just put it in a small nutshell very clearly is that we are targeting clearly an high teen plus growth in terms of moving ahead as the CAGR growth.
Got it. So essentially, you're looking to beat the industry growth rates.
Oh yeah, absolutely. Oh, absolutely, absolutely. Yeah. In fact, the confidence from the fact basically is that our composition on to add to size point is that we had about 8% contribution in the digital engineering coming in the last year, and we have doubled it in the budget to 16% in the current year. And we are confident of making it to that level with the kind of push with acquisition through Avara, which we did last year. And the second scenario is that the trend between the Q4 of last year to Q1 of this year, the order book position has almost moved up by about 90% comparing to what it was. It could be a minuscule size, but I think 90% is a good measure in terms of how the order book has moved on the digital engineering side. So this will give you the fact basically is that how we are trying to get focused out, and then we are confident that this kind of growth will happen. Barring that, I'm giving an exception very clearly. The current financial year, you can't expect fabulous growth or whatever it is, we are trying to be very cautious in observing the market, and we are trying to take a measured step both in terms of cost and revenue.
Okay. So, all the best to you and the entire team at Cigniti. And thank you so much for taking out time for this interview and, telling your story to our, retail investor base.
Yeah, thank you very much, and wishing good luck to all the investors, and have a great day. Thanks for hosting us again today. Thank you.
Thank you very much, Milan and team. Thank you.
Thank you, Mr. Sairam.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.